Hi there, welcome to Kneppyinvests. Today's video, I'll be sort of dividing it into two little sections. A bit of an update to the performance of Kneppy's portfolio, update number 18. To be honest, not a lot happened last week, so not much to really discuss. My portfolio's performance was very similar to the benchmark. But what happened with SG Fleet is a little bit more interesting. This company went into a trading halt on Wednesday. They were supposed to come out of the trading halt on the Friday, but instead of coming out of the trading halt and telling us what this material transaction was, they went into a suspension. So more than likely, a material transaction tends to be good news for the company and its shareholders, and more than likely it is a merger or an acquisition. I think they are possibly going to be acquiring one of their competitors in this space. So this is something I've been waiting for quite a while. I maybe have discussed this in a previous video. One of the reasons I did buy into SG Fleet, not only was the share price going up, but I did think there was that potential of mergers and acquisitions in this space simply because there's about 10 competitors, and I think it's ripe for those amount of competitors to come down. So let's get stuck into the video. In previous videos, I focus on the XJO daily. This week, I'm just looking at the weekly chart for the XJO, so you can see what has happened since not only post-COVID-19, but even pre that. So pre-COVID-19, we were heading higher. We got above 7,000. We were above that level for about 5 weeks before COVID-19 hit. And since then, we've been trying to get back up to that level. We quite still haven't got back up to 7,000. We are trying, but over the last, since the start of this year, so almost 3 months, we have been going sideways. So not a lot of action with the XJO in terms of upwards movement. We're still in a bit of a trading channel, upward sloping trading channel, but we will need to get towards 7,000 for that trading channel to be maintained. Probably the other thing I did notice when I looked at this chart is the decreasing volume since the peak in the COVID-19 financial panic. So it looks like people are going to be less and less interested in the stock market, and that's expressed by the lower volume each and every week. And that could be a sign of a bit of a toppishness with the market. Now, overall, the last week we did go up 1.7%, which is good because we did have a down week the previous week, but again, we seem to be going up 1 week, down the next week. So it'll be very interesting to see what happens in the following trading week. Overall, the performance of my portfolio was up 1.3%, so very close to the benchmark. The best gains for the week were PAC Group, Pushpay, and Costa Group. So particularly Pushpay, that's a very high conviction buy, and I'll get into the chart in regards to that company, and when you see the chart, you'll see why that was a high conviction buy. Pushpay was not as high, but they did have some interesting news during the week, which did push their share price higher. And the last 3 trading days does look interesting, a potential flag developing there. And Costa Group, that's been a success story ever since August of 2020 when they released the half yearly, and management was quite optimistic about their future performance. Worst performing companies, TPC. Now, the reason I'm a little bit below the benchmark this week, and one of the reasons was TPC. This is a highly illiquid company, and we did see a little bit of selling come in, forcing the share price down. So I'm not concerned I was a little bit below the benchmark simply because of TPC. Now, Australia Broadband, a little bit different. They did have a nice little uptrend over the past few months. There is potential that uptrend now has been broken, so that's a potential sell. Before I'll go into discussing the best performing companies of the week, I just want to do a discussion about SG Fleet. I was going to do a video on this, but I thought I'd just incorporate that discussion into this video. So SG's Fleet share price has been going up ever since October last year. So it's gone from about $1.65, $1.70, all the way up to $2.60. So it's been a good performer during this time period. And one of the reasons I did buy into SG Fleet was waiting for consolidation within this space, this novated car leasing space. Now, they went into a trading halt on the 24th of March, which was Friday, and they mentioned the 2 magic words, material transaction. And whenever I see material transaction, there could be a few things that is, and one of the things it is a possible merger, acquisition, or that could be being bought out. Now, they went into a suspension on the 26th of March, and they did mention the 30th of March when they're coming out. And they also again mentioned the material transaction. So it looks like whatever transaction this is, there's still a lot of details that has to be flexed out. So what does material transaction mean? So in the past, I've come to the realization that usually material transaction is good news. So it's an acquisition being bought out, which is probably the best news for some shareholders because that's usually means the share price will go up a fair bit. Acquisition doesn't necessarily mean so. So in this case, all I did was Google SG Fleet, and what came up was two articles from the Australian Financial Review and the Australian. They both were behind paywalls, so I couldn't really look at these articles, and I don't want to pay the fees. And all I needed was some sort of headline. I got the headline I needed. SG Fleet closes in on lease plan. So I had something to work with there. I wanted to know who really were lease plans. So lease plan are actually a fairly big international company based out of either Denmark or the Netherlands. I think it's Denmark, Copenhagen. That's where the headquarters are. So they're a large company. Now, they've been talking about selling off their Lease Plan Australia division for a few years. And in one of the articles in 2017, we did see the list of all the major players within this space. So Lease Plan Australia did have the largest market share in 2017, 16%. SG Fleet had 7.1%. And just behind them was Eclipse with 6.9%. There's been talks or discussions in the past about SG Fleet buying out Eclipse, and those discussions have fallen through. So Eclipse is another company that has the potential to be bought out, and that's one of the attractive things about that company. It seems like a lot of other companies are wanting to buy that company out. I think Macmillan Shakespeare is another potential company that could buy out Eclipse. So it does look like, based off 2017 numbers, that SG Fleet is buying out or potentially acquiring a larger competitor. The next thing I want to do is just compare the financials of both companies, and fortunately LeasePlan did have a financial, they do release their financial reports. So I looked at their 2020 annual report, and within that they did to give some details about how the Australia division is performing. So revenue and net profit before tax, that's the only two numbers they gave us. So LeasePlan in 2020 had revenue of 470 million. So they did report in euros and had to convert that to Australian dollars. And net profit before tax was 33 million. And SG Fleet's revenue of 452 and net profit before tax of 52. So it looks like LeasePlan is on a fairly similar size to SG Fleet based off 2020 numbers. Now to the best performing companies of the week, and the first one is PAC Group. And every single time I talk about this company, I'm just going to mention how bad their logo is. A very basic logo, but they probably think they don't really need a fancy logo because they're just a sort of a very simple company. Now, even though it's a very simple company, in my opinion, the chart looks brilliant. This is one of the best looking charts I've seen for a while. Not only did we see a breakout in the middle of March on their half-yearly report, we've seen massive volume come into the market. So typically when you see massive volume like this is fund managers getting excited about a company. And when you get lots of fund managers getting excited about a company, buying into that company, that really can force the share price up. So it's one thing I really look for is an increasing volume, fund managers coming in, because fund managers are the ones who drive the share price higher for companies like this. So this was a very high conviction buy when I bought on that breakout, and the share price has done exactly as I thought it would do since then. And last time I looked, it was at its high, not its all-time high, because if you go back about 3 or 4 years, the share price of PAC Group was quite a bit higher. It went through a long downtrend period, consolidated for a while, and now it's in an uptrend cycle. So this is a definite sort of company you really don't buy and hold for the long term. You wait for when the share price is in an uptrend, buy and hold at that point. When it goes into a downtrend, that's when you sell. So that's what I'll be looking for as a sell signal, is when this uptrend is over. On to Costa Group, and this is my second longest holding within this portfolio currently. I've held this since August of 2020 when I started this portfolio. South 32 is now my longest holding. My previous longest holding was BlueScope, but I sold them out of them last week at a 55% profit. Now, Costa Group is a recovery story, and that was a very good signal back in August when they released their half-year results, much more optimism within management, and that's the main reason I bought in. And ever since then, the share price has been in a very well-defined uptrend. And in their full-year results, it was another breakout, going above $4.40. It tested $4.40 a few weeks later, and it succeeded that test, and the share price went higher. And right now, it's at the recent high. Not an all-time high. Its share price of Costa Group, just like PAC Group, has been significantly higher in the past, and another potential, not a buy and hold story, but just hold this when it's in an uptrend. And when it gets to the top of the uptrend and the uptrend fails, that's when you sell out. The most recent purchase in my portfolio was PushPay just over a week ago. Was a low conviction buy. We were seeing a high-low setup and a bit of a developing uptrend. That uptrend was confirmed on Monday at this point, when it tested the uptrend and then bounced off it quite brilliantly the next day, when the company announced that Sixth Street, investing company in America, had taken a holding. In fact, they bought out from the founders, and the market loved that news. I was a little bit surprised how much it loved it. Share price rose over 12% on the day. We have actually seen a bit of a flag develop in subsequent days, which is quite a bullish sign. So even though I bought into PushPay with low conviction, my conviction has now risen, and a bit of a high conviction around PushPay over the short to even medium term. Onto the worst performing company, and that's TPC Consolidated. Now, it doesn't concern me that this was the worst performing performer of the week, simply because this is a highly illiquidly traded company. And these sort of companies, research has shown, can be actually the best performing companies in your portfolio if you do have the patience. And that's a problem now. There are some holders don't have the patience to hold for the long term. And because it's illiquidly traded, when they decide to sell out, become impatient, it actually does force the share price down. But what we've been seeing happening in the last few months is a sort of exact replica to what happened in August last year, just after they released their results. Results have been stellar the last 2.5 years. The market has loved the results, and as soon as the buying based off those results has dried off, we have seen a very small amount of selling, which can drive the share price down a fair bit. And as soon as that selling dries up, we do see the share price start to rise again. So I bought this company way back in August at 95 cents. The main reason I bought was the increasing volume. So it's one thing I really do look for, increasing volume. And as soon as they released the results, their yearly results, I could see why the volume was increasing. Really good results. 8-cent dividend they announced. So in fact, my dividend yield for this buy has been significant, because they've also announced another 8-cent dividend. So I've got 16 cents of dividend for initial buy of 95%. So that's like almost 18% dividend yield for this company at the moment. Now, we did see the share price run up from $1 to $1.60 on the back of those results in August. And then we just saw the buying dry up and selling came into the market, but not a lot of selling. Exactly what you want to see. Not a lot of selling. That selling then dried up as well. Now, the half-yearly results released on the 26th of February at 4:28 p.m. That was the next breakout. Another good set of results for this company. And the share price went from just below $2 all the way up to nearly $3. And at the top there, we saw not as good volume as we saw in August, but still good volume. And as soon as that buying, dried up, the share price started to retreat again on much lower volume. And they also announced this 8-cent dividend on the 9th of March. They didn't announce it that day. That was the record date. Or maybe the ex-dividend date, one of those two dates. Anyway, so the interesting thing here is on this date in August, that could have been the capitulation date. That's when, those last shareholders who got frustrated with the share price coming down, too impatient, they decided to sell out at the low. And that's the one good thing, or one thing you look for, is a bit of capitulation. Those bad shareholders, bad traders, decide to sell out the low on higher volume. And as soon as they sold out, the share price started to rise again. And that's potentially where we are right now, with another little peak or spike in volume. And as soon as that volume came in, we started to see buyers come back into the market. And we did see the share price rise on the last trading day. And finally to Aussie Broadband, this is also a worst performer. It was in a good little uptrend. That uptrend looks like it might have broken on Thursday. Not a lot of volume came in to break it through that trend line, but I wanted to hold this as long as possible. I do think this has a really bright future, so I'm not fairly hesitant to stay out of this company because I think over the next 5 years this can be a stellar performer. So I'm gonna have to think about this, whether I do sell out and just wait for a new uptrend to develop. So that's all I've got for this update 18 to Kneppy's portfolio and SG Fleet. Hope you've enjoyed this video. If you have any comments, leave in the comments section. Otherwise, I'm not a financial advisor, so if you do need financial advice for your own circumstances, make sure you seek out someone who is qualified and can speak to your own financial needs. That's all for this video. Have a good day. Bye.